Good afternoon. Today is Monday, January the 9th. The time right now in Singapore is 12:36 in the afternoon, and this is the second week of 2023. And of course, the last week we have seen some major movements, especially on Friday, largely due to the non-farm payroll results, and of course, it led Wall Street higher. And in my opinion, those numbers that actually excite market to the upside is a little bit of an anti-climax because the number came out was not what the Federal Reserve. If I'm the Federal Reserve Chairman, when I look at those label numbers that were released on Friday and even on Wednesday, where the ADP numbers was more than market expected. You see, the whole idea of the Federal Reserve hiking interest rate is to basically kill off demand because they believe inflation is caused by rising demand. So in order to see evidence that the higher interest rate has actually impacted demand by reducing demand, they have to destroy jobs. But what we are seeing last week, first, the ADP number came up more than expected, means more jobs are being created. It's just not exactly what the Federal Reserve would love to see. Okay, they want to see less job being created. Ideally, it create no job at all. Okay, but the number came out was more than expected. And then on non-farm payroll, again, market was expecting about 200,000 new jobs being created, but it came up to 135,000 new jobs. Again, this is the wrong number. On top of that, we have unemployment rate from 3.7% drop to 3.5%. What the Federal Reserve Chairman, if I'm the chairman, I would love to see a number worse off than 3.7%. Okay, I need to see higher unemployment rate, but this is not what I'm saying. So basically, in the shoe of the Federal Reserve, they need to destroy jobs, and right now the numbers is not giving that confirmation. So as the Federal Reserve consider whether how much to hike in the next round of their FOMC meeting, which is going to be due on February the 1st, then we will have to come to the conclusion that the Federal Reserve is not able to slow down the rate of rate hikes because the number is not supporting that narrative. So as the market goes up, we have to remember higher interest rates is definitely a negative for equity markets. So last Friday, when the market went up the way it did, I also have this big question mark is that, is it sustainable? Knowing that the Federal Reserve cannot slow down the rate of interest rate hikes. So this is building the stage for a major unraveling of equity prices going forward. Now, I have an opinion somewhere in the middle of this month, ideally on the 16th of January, if not on the 23rd of January, both are Monday. I think between the two dates, I think one of the date itself, I think we may see a massive unraveling of equity prices. What will cause that, I will have no idea. I'm just saying that based on timing cycles, I think these two dates on the 16th and the 23rd is going to be very crucial. If I'm going to be long in the near term as prices in on Wall Street, whether it's a Dow Jones or whether it's the S&P 500, as it rises, I will try not to hold a long position over the weekend. Come this Friday, if any long position that I should take as a short-term play, I will want to square up before the weekend. Same thing if it does not happen on the 16th, which is the following Monday, then again, if the next week the market continue to go higher, I would not want to hold any long position going into the weekend of 21st, 22nd, because again, those are very hairy for me because over the weekend when the market is not open, something else may happen, which may not be directly involving the economy. I'm thinking something bad may happen in the war in Ukraine, or something systematic is going to happen. And if the market is closed on weekends, it does not give me the chance to participate, whether it is to close up my long position or to take up a new short position. Let me just say, I try not to do that. Okay, so this is my opinion. You can take it into advisement and see whether you concur with this view. Okay, so in the meantime, the Dow Jones actually is now at 33,718, which is a lot higher for the week itself. The week itself, we all know December is at the market end up as low as 32,573. So it is major improvement. The market has gone up more than 1,200 points from where it was last week. Okay, so based on this, the market right now at this current price is barely above the 50% pullback of the 34,712 to 32,573. So this market here is pivotal. Why 50% is important? Because based on previous performance, 50% mark has always been pivotal. The market may do a counter trend rally. Sometimes it gets stuck at the 50% mark. And if not, it will be stuck at the 61.8 Fibonacci retracement level. So for anybody who is somehow familiar with the Fibonacci ratios, 50% is not exactly a Fibonacci ratio, but 61.8 is a major Fibonacci ratio. So sometimes the market seems to have problem, when it's having a retracement, it gets stuck at the 61.8%. So again, we have to look forward to see whether it is the case this time. Okay, so be careful as you watch the market goes up. Now, in the S&P 500, we are also showing the same thing. The market has pulled back, not at 50%, but at 38.2%. Again, this is also something that we can measure, but I think the 50% mark is probably the more relevant levels, because the 50% mark somehow, whether you are following Elliott wave or Fibonacci, or whether you are following Gann theory, the 50% mark is very, very important. So a lot of technical traders do watch out at the 50% retracement marks, which we are going to see in tonight's trading, whether the market can actually go even higher. That level is 3,932. Okay, so do watch out for this upper level here. Okay, but based on so far, we can see the rebound from the October low at 3,491. We can see the market has gone up to 4,100. So this entire move here, you can see the structure is a three-wave structure. Now, if you see a three-wave structure, technically it's a corrective pattern. So what it means that after the corrective pattern ends, ideally it's a very simple 3 ABC move, and then that's it. Market will resume its original trend. As you can see, the original trend is all the way down. This is a very bearish market by and large. Okay, so if this is a simple ABC, then of course that's the end of the story. Market is getting ready to resume its slide down and perhaps take out the October low of 3,491. But life cannot be that simple, right? Sometimes the market have a more complex corrective pattern. Maybe we have a double zigzag. This is ABC, considered as what a zigzag. But if we have another set of ABC, the market can actually go a lot higher, perhaps even to challenge the August high of let's say 4,325. So that means we do not know what is this structure going to be like. If you take out the 4,100, that means it's going to be a more complex kind of corrective pattern. But one thing is for sure, this rebound is a correction. Okay, so it does not say that the trend has changed. The trend has not changed. The trend is basically favoring the downside. Okay, so the higher you go, the better it is, because at some point we can always anchor at a much higher levels for a short. Okay, and be very careful about stock market going into a bear market, because if it ever collapse, it's going to be so fast, so swift. If you get caught on the wrong side, there is a good possibility you may not be able to come up at any good price. Okay, so I love bear markets, and I always very keen to participate in any kind of bear market. But however, having said that, this last year we saw the weakest link in US equity market in terms of the equity index itself. This is the one. This is the one that is the weakest link, because as the whole world went into lockdown as a response to the COVID-19 back in 2020, everybody was asked to stay home. Nobody can go to office, and of course, tech stocks benefited from everybody being locked up at home, and then they have to pivot to some kind of online kind of working. Okay, so that was then. Now the pandemic is more or less, we are able to move around more freely. We are able to cross border to travel now, and China has opened up its border to the rest of the world, allowing its citizens to go out, as well as for travelers to go into China. So everything seems to be going back to some kind of normalcy, and obviously that is not good for tech stocks, because that boom that we saw during the initial stages of the lockdowns in 2020 is now practically over, and the need to buy more tech equipment now it become less important. And we can see that the valuation as a result of the lockdown, where everybody pivot online, caused tech stocks to go to unrealistically high valuation. And now that valuation is coming back down to earth. And even after losing more than 33% last year, for tech stock, the Nasdaq 100 is still considered to be overvalued. So downside potential is always there. So we want to see if the market breaks the October low, which is 10,440 in the Nasdaq 100, then this market can go down big time. Okay, so I want to sell this particular index. So right now, it has not even recovered anywhere near 38.2%, not to talk about 50%. If the market can recover 50%, I'm looking at 11,475. That will be a great level to consider if the market can actually go up there, and then we want to see whether it can continue with the momentum upside. Okay, if not, then we're looking for a sell signal on the downside. Over in Asia, we can see that the Hang Seng market, represented by the this is the Hong Kong equity markets. You can see that it is on steroid. Since bottoming out in October last year, we can see the market low was 14,597. This morning it is at 21,000, almost 500 points. So you can see that this is a market that moved up more than 6,000 points in just, okay, you consider January as 1 month, but we are only in the first week of January. We can see that the market has actually gone up in 2.5 months, 6,000 points. This is massive. So the thing is why? Of course, we all know over the weekend, China has actually opened its border with Hong Kong. Okay, so the Hong Kong sentiment has suddenly become very, very bullish because they were expecting an influx of Chinese consumer to come in to shopping. Okay, but the timing can be a bit off. Okay, this bullishness in Hong Kong may be a little bit premature. Okay, so what is happening is that in 2 weeks time we're going to see the Chinese community everywhere in the world celebrating the Chinese New Year, and traditionally this is the period in which there's going to see a mass migration of people across and the entire Chinese mainland. People who for some reason go to the coastal city to work now will be wanting to go back to their provinces. Okay, so that will means that the expected influx of Chinese consumer into Hong Kong may be missing until after the Chinese New Year celebration. So this could be a little bit overblown right now, but optimism can be seen in the equity markets in Hong Kong, and this is definitely doing very, very well. Short term, I think the market may even go up to 22,000. In fact, it may even challenge the last June high of 22,450. Okay, so this is all remain a possibility, but like I say, this bullishness in expectation of an influx of Chinese consumer into Hong Kong territory may be a little bit premature because the timing was not right. Because if it's going to be a Chinese New Year, mainland Chinese is not going to fly into Hong Kong, they're going to go back to their own provinces. Okay, so this has traditionally been the mass migration. Then after the Chinese New Year is over, then people will start to trickle back to the coastal cities, and perhaps only after that, but assuming there is no uptick in the surge in the COVID-19 variants. Okay, so if that's the case, then of course the expected influx of Chinese consumer may actually happen. But in the meantime, the market is so bullish right now, and we do not want to stand in the way of this bull. Okay, obviously the market right now is doing a counter trend. As much as the market has rallied, this is a counter trend rally. The dominant trend is down. You can see this market has been down for so many years, has been down and down. You can see that the market actually high here was actually traded in February of 2021. So it was a 2 years bear run. Okay, so this market having a change of fortune, but it is still in a bear market. So be very careful about chasing this ever higher at current prices. So we want to see whether the Shanghai Composite Index is showing the same phenomenon. Yes, the Shanghai Composite Index, which is a major equity index in China, is also showing signs of bullishness, but it is not in the same manner as in Hong Kong, because Hong Kong has too much problem. Even before the lockdown, we have this student protest back in 2019. So Hong Kong had a series of bad press, okay, and it has never quite recovered from it. But in China itself, of course, over the last 2.5 years, you can see this intermittent lockdown, especially even in the major cities like Shanghai, where a lot of manufacturing does take place in Shanghai. We can see that has caused a lot of damage economically, because this intermittent lockdown does not allow businesses to actually plan forward what they can do, because if somebody in a factory floor get infected, the entire factory will have to lock down, and this is causing a lot of enterprises deciding that maybe it's a wrong time to be in China. They have all decided to pull out of China. So we can see that over the 2.5 years, the intermittent lockdown has done a lot of damage. Now with a new team in charge, okay, the previous prime minister is going to step down soon, and a new team will be taking over the economic team, and the new prime minister definitely have economy in his mind, and he definitely have to rebuild the economy, and that means to have maybe it has a lot to do with the sudden removal of all these COVID restriction. Okay, so this is a very sudden move. The market was not primed for it, but that is a good news. But on the other hand, if the Chinese consumers are back to where they were before the lockdowns, and Chinese factories are humming along, they are producing more goods, and more goods are exported, and more people are consuming, that will lead to the problem. That will be a problem for the Federal Reserve, because if the Chinese economy does well, they started to get their factory back online, that means they are going to sell more, and that is going to cause inflation to flare up all over again, which is not something the Federal Reserve wants to see at this particular moment. So it is a dilemma. China needs to come back in order to give the world economy some kind of a ballast, okay, to float. On the other hand, if China is doing well, the fight against inflation is going to be monumental. It's going to take away the what you call that, the progress that we have seen over the last 6 months. We can see that in the US, headline inflation peaked in June of last year at 9.1%. The last number that we saw in December, which is last week, we saw the latest number for December is 7.1. So they managed to shave off 2 percentage points off the headline inflation number. But if China comes back again, this inflation number is going to come rolling back, okay, maybe into double digits. So it is a bit of a good news and bad news, depending on how you look at it. But by and large, the Shanghai Composite Index is currently doing well at 3,186 this afternoon. Whether or not it can overtake the last month's high at 3,225 remains to be seen. But upside is still going to be a lot of headwinds, okay? We have the September high at 3,278, and then we have the August high of 3,308. So again, there's overhead. There's going to be a lot of barriers before we can actually say, yes, the mainland market is coming back, okay? Right now, it is not. Now, we take a look at Nikkei. Nikkei is definitely having a different fortune altogether. From the get-go in December, when it peaks at 28,200 points, the market has been sliding, and not just sliding, it's basically falling apart. And the low traded last week was 25,661. The cash index, this is referring to the Nikkei 225. And the main reason is because the Bank of Japan, 5 days before Christmas, they decided to do something unexpected. They decided to leave the cap on the bond yield as far as the Japanese government bonds concerned. This is totally unexpected because throughout the whole of 2022, where the rest of the world has been hiking interest rates aggressively, the Bank of Japan kept their interest rate at negative 0.1 because they can't afford interest rate to go up. Because you have to understand, in terms of the debt burden in percentage term, the Japanese has the world's largest debt burden. Their debt to GDP ratio is 240%, meaning for every $1 income, there is $2.40 of debt that they have to carry. So in the face of this mountain of debt, any increase in interest rates will definitely add on to the burden of servicing this massive debt. So the Bank of Japan has kept the yield on the JGB, which is the Japanese government bonds, no more than 0.25. But I think they know this is a losing battle. The longer they try to keep this artificial cap, okay, it's going to be very expensive because the bond market wants to come down. Okay, because if the bonds goes up, the bond yield goes up, the Japanese price, the Japanese JGB price, which is the Japanese government bonds, is going to come down. So this is going to cause a systemic risk. But I think it is come to the realization, the governor of Bank of Japan is a guy called Kuroda. He's going to retire in April. So I think he's trying to clean up the house and maybe institute a exit from the negative interest rates that the Bank of Japan has been maintaining it for so long, since the start of the COVID-19. So now the market believes that the day of cheap money funding coming up from the Japanese yen is probably over. Going forward, we can expect higher interest rates to come in. Now, high interest rate is a double-edged sword, okay? On the one hand, they cannot forever keep this artificial lead on the bond yield. On the other hand, if they allow the bond yield to rise, it means to say interest rate to rise, it will cause an implosion in the Japanese government bonds. So it's a situation in which do they die, don't do, they also die. So between the two devils, they have to find one that is less evil. So right now, I think the pressure on the Japanese government bonds is so tremendous, they will have to allow it to float even higher. On 20th of December, the Bank of Japan allowed this cap, okay, to move from 0.25 to 0.5. Now the market is already edging at 0.5. That means the market wants to go up. The pressure for the yield to go up is so strong. I think sooner or later we're going to hear more news on this front. That is causing Japanese equity to fall apart, because if bond yield goes up, means interest rate goes up, it is a negative for equity markets because the cost of financing is going to be more expensive. Okay, so this is causing a sea change in the Japanese equity markets. Okay, if this market take out 25,000, it's going to go all the way to sub 25, okay, obviously, okay. So we will have to watch how developments unfold in the Japanese equity markets. Now, in the subject of yen, okay, while the whole of last year, while they are trying to cap interest rates below negative 0.1, okay, basically just to hold the market, they have to sacrifice something. And the yen, the Japanese yen was the sacrificial lamb. While they are trying to hold the yield on the JGBs, in the meantime, the Japanese yen has been sacrificed. You saw last year up to October, the dollar yen went up to near 152 to the dollar, and that is historic because to lose 34% in a single year for any currency is going to be massive. Of course, price has come back down below 130 in the yen. Okay, as you can see, in January of this year, we can see the low traded at 129 half. So this is good. But then again, if the market believes the Bank of Japan is going to liberalize and do away with the negative interest rates, then logically, people wants to buy the yen, and that is seeing that. And by this, we are seeing it in a dollar yen move. Now the dollar is coming back down against the yen. Okay, so for 134.80 last week, now this morning you can see the market slide back. There's a possibility it will go below 129. Okay, and we'll see possibly 123 half levels can be actually be seen. This is my immediate target for this dollar yen move. Okay? We'll see whether it is true or not. But over the long term, I'm still very bullish at dollar. Just that currently the sentiment seems to be favoring the yen for now. Okay, now because the reading in the non-farm payroll resulted in the dollar coming off, so all other currency, because it's like a seesaw, right? If dollar comes off, all the other major currencies will have to rise. And this is what happened from a low of 118.35 thereabout. You can see the sterling went up to 121.5 half. Okay, so this is quite a big move. This is a 300 pip move. Okay, so the whole idea is this going to be sustainable? Okay, over the long run, the fundamentals in the UK is definitely not good. It could be one of the major economies to slip into recession early this year. So if the economy go to recession, obviously the currency cannot remain strong. Okay, so over the long medium to long term, I'm still bearish on the sterling. In fact, I think it will go down below parity this year. Okay, so do watch out for the massive unraveling of all the other major currencies relative to the US dollars. Okay, now over in the euro versus the dollar, we can see that the same thing happened. We are also seeing the same thing happening in the euro versus the dollar. The euro is went up to as low as 104.80 last week before it got bumped up on the back of the dollar coming off as a result of so-called good numbers coming from the non-farm payroll. Actually, it's not a good number. To me, that's a bad number. So we want to see how far it can continue with this charade of selling the dollar. Right now, we can see that the high traded so far last week was 107. So the first barrier to higher prices, obviously, is going to be 107 to 107.35, which is the December high. So these two barriers need to be overcome. And even then, if we can overcome, it is still going to be within this rising channel here. Eventually, the market will have to come back down. So over the long term, I do believe this euro as a currency may fail altogether. What I'm saying is that there will come a day we may not be able to see this currency anymore, because the problem in Europe is not just economic. There's a massive deindustrialization going on because they do not have cheap, efficient energy supply. Ever since the war in Ukraine and ever since they cut themselves off from the import of natural gas from Russia, now they are having to import all this liquefied natural gas all the way from United States, which costs them 3 to 4 times more. Okay, so in terms of cost effectiveness, it's definitely not cost effective. And because of the unreliable supply of energy, a lot of industries are moving out of Germany. Okay, because Germany is like the engine, the head of the train. Okay, and if Germany is not doing well, the rest of the Eurozone will not do well, because after all, Germany is the manufacturing powerhouse. So because of the inability to secure reliable energy prices and supplies, this is causing a major deindustrialization. A lot of companies are moving out of Europe, especially in Germany. They are moving across to the United States because over there at least they can get reliable source of energy. Now there are some that decided to pivot towards China. So we can see that late last year in December, we can see the German chancellor actually make a personal visit to China and try to drum up some kind of economic links with China. So we can see that so industries are leaving Germany. So that cannot be a good thing, right? So if that being the case, and if the war in Ukraine actually escalate, which there's every possible sign that it may actually escalate, Russia has just gone to the IAEA, which is the International Atomic Energy kind of regulators and surveillance agencies. They say that Ukraine, they have evidence that Ukraine may actually detonate a dirty bomb in the airport. So this is definitely not a news that we want to hear, because it means that it's going to get, the war in Ukraine is going to get a lot more serious, and it may even be enlarged. And if that happens on top of the economic problem that we saw in Eurozone, you do not want to hold on to that currency. In my view, that this currency is a disaster waiting to happen. Okay, so I'm not bullish at all in this currency. So based on that, I want to look for levels in which if the current up run, if the momentum started to frizzle out, I want to look for levels to actually sell and actually hold to my long short position for a long term. Okay, so I want to hold on to this. I'm actually very, very bearish on this particular currency. What about Aussie dollars? Aussie dollars, we can see that also have a massive rebound this morning. Is testing the testing the 70 cent. Okay, at 06930 this morning at midday. So it's already significantly higher than the last month high of 0.6893. So where can this market go? Okay, now remember last year the market has been hovering just under 80 cents. 80 cents seems to be a long-term cap. So as the market goes up, immediately my target for this move is at 71 cents. Okay, so I still think that there's still a possibility for market to continue edging higher to 71 cents level, but then we will have to see whether it can cross beyond that. Okay, what about dollar Canadian? Dollar Canadian is obviously coming apart purely because energy prices are also falling, but it does not actually relate to oil right now. It's more like the sentiment in the dollar is pretty poor right now, because this means the Canadian dollar is stronger than the US dollars, and that can only happen typically if the crude oil prices goes up. But right now we are not seeing the crude oil prices going up. In fact, crude oil prices has actually went down last week. Okay, so it's definitely not due to higher energy prices that benefited the Canadian dollars. It's more on the sentiment on the dollar right now. The US dollar sentiment is pretty poor, and we can see that happening in the dollar versus Canadian. Okay, at 1.34, which is the lower boundary of my move here, because if this is a three-wave pullback, then it should stabilize somewhere between the current price to about 1.3465, and it is already near the 1.34 levels. So it is definitely pushing it. So if the market breaks 134 and continue to trade lower, then this technical pullback, which originally is just my idea that this is going to be a technical pullback, may develop into something else. We will have to see how the market develop from here onwards. Whether I'm going to maintain a bullish view on the dollar versus Canadian remains to be seen. But this market is bullish. Okay, over the daily time frame, you can see that the bigger box here is in green. To me, that is my visual inspection saying that this currency pair is bullish over the long term. Okay, now over in crude oil, like I mentioned earlier on, the Canadian dollar's strength is definitely not due to the strength of the crude oil prices. In fact, crude oil prices went up to $72.43. Earlier on, as the market stabilized at $70 per barrel, market went up to a high of $81.50. I was holding on to long position, but I got out at $80.78, and I went back in to buy as the market was sliding down, thinking that this pullback is technical in nature, and I went in to buy at $76. Obviously, it's not working out for me now because the low is at $72.43. But this morning, you can see market stabilize a little bit, go back to $74.80 thereabout. So hopefully, this is the bottom. But however, I do understand based on I have expectation somewhere within the next 48 hours, I think we can see a major reversal happening in energy markets, and that may even extend to natural gas, which has been falling way below, even at prices below the conflict started in Ukraine. Okay, so we can see that I have a view. This is time sensitive. I think within the next 48 hours, by Wednesday, we probably will see a massive rally to the upside. And if that's the case, then the price may actually go beyond $81.50. We will have to see whether this prognosis is going to be correct, and I'm hopeful. Okay. Now over in Precious metal, we can see this morning market went up to $1,879 and almost 90 cents. And this is the highest since last June. Okay. Last June, the high was $1,879 and 45 cents. So this morning high exceeded those June high by at least 40 cents. So is this telling us something? Too early to say. Although I am very bullish on precious metal as a whole, but at current price, I am definitely not going to be buying because this is an insane price to buy. Okay, I will hope the market can actually pull back, ideally somewhere near this support line here. It may or may not happen, but it doesn't matter. I have patience. If the market do pull back, then I will see if it's going to give me a chance to get back in on the long side. I want to stay long precious metals in 2023. Okay, and obviously the same thing may also happen in silver market. This is the spot silver market. Silver prices did not rally the way gold prices did this morning. So the high traded was in December, $24.55. You only pull back to $23.12. So you can see that the rebound in silver prices is not as robust as what we saw in gold earlier on. But again, this is a rising channel. In fact, I am more bullish on silver than gold. Between gold and silver, if I have to make a choice to invest in one of them, then I will pick silver hands down. Okay, for some reason there is a major shortage in silver prices. So we all know silver is not just a precious metal, it's also the industrial metals. So it has actual physical use applications here. So for this round, okay, I am definitely more bullish on silver than gold. So again, wait for a more sensible level to see if I can buy at a decent level. Okay, now over at Bitcoin, we are going into cryptocurrencies. We can see this morning the cryptocurrency actually edged higher to above $17,000. Okay, so this is a new development. As we are speaking, the market went up to a new high for the day at 17,266, almost $67. So this is seen on the back of a technical rebound. Okay, this is a three-wave rebound. Market right now is near the 50% mark, which should see Bitcoin targeting the $17,333. Okay, so again, 50% has been pivotal. We will see whether there's going to be any reaction at this level. So because the market sell off very deeply from 18,375 all the way to $16,300. So we can see this massive this so-called rebound this morning is pushing the envelope. I want to see whether it can sustain above the 50% mark. Okay, so again, technically I would not be buying this one. In fact, I'm hoping to see some kind of a pullback. Okay, but over the long term, this is a very bearish this market. Let me see. This market is actually very bearish. You can see the big picture here. This big, huge pink color box on the daily time frame. This is a very bearish market. Okay, a lot of analysts are saying that we may not see the bottom in Bitcoin until it hit 10,000. So is it going to happen? Who knows? Maybe it will happen. Okay, but for the time being, the 50% mark at $17,333 seems to be an area in which I'll be keenly watching. You see, it's like it can actually sustain. Over in the Ethereum, I think I got on the wrong side again. As the market fall from 1,351 all the way to 1151. This is a very sharp pullback. As the market goes up, it does look like it's corrective in nature. So at the 50% mark, I actually enter a short position at $1,250, and then I enter another secondary short at $1,270. So between the $10 difference, I actually take up two short positions, but we can see obviously this is not working out for me. The current price as we are talking has edged up slightly marginally more to $1,315 thereabout. So this move here appears to be a lot more robust than I was anticipating. So I want to see if it can sustain beyond the December high. Okay, again, we can see that there is this overhead resistance line. Okay, in order for the market to go up to this target price of 14.25, it must take out this resistance line. So that it remains to an unknown factor whether it can or cannot do it. Okay, so I'm going to hold on to my short position for a while and see what happens. Okay, but if the price comes back somewhere in between my prices, I will just get out and watch. Okay, I'm not going to take the risk in the meantime. Now, Ripple has not been so robust. We don't see the same kind of upside movement in Ripple this morning. In fact, the high traded was last week at 35 cents. So this high has not been violated so far. Even if it does, it will have to contend with this support line, this resistance line over here before it can challenge the 39 cents level. So again, we want to see. But the only thing that can cause the Ripple to move is some kind of verdict between the SEC and the Ripple Lab, because this lawsuit has been ongoing for so long with no end in sight. We are still waiting for some kind of a verdict to tell us that either they're going to win the case or they're going to lose the case. Of course, a win for Ripple Lab is going to be a plus. Okay, so again, the market has need information on the status of this lawsuit between the SEC and Ripple Lab. Now, Binance Coin obviously has also gone up, and in fact, it has gone up to $280.90, which is more than what I expected. Although I have expectation the market may be going for $270 to $280. So the thing is that it has actually happened. That caused a little bit of disbelief in me, because this coin here is a token for Binance as the exchange. Okay, so lately we know that going into December, the US Department of Justice is going to sue Binance Exchange for money laundering. So under this lawsuit, the settlement cannot be good. But the fact that they say, in fact, you can see that the price peak in November at $317.60, and it has fallen all the way to $220. So this pullback, I can only see as a technical rebound and nothing else. Okay, it's not that they have win any kind of challenge by the US Department of Justice. So in fact, this is setting up to be a nice three-way rebound. Okay, we will have to see whether it has able to continue further. The Dogecoin is not a coin that I would normally want to monitor, because it's a meme coin. The only person who is very excited about this particular coin is, of course, Elon Musk. Without Elon Musk, this coin has no reason to exist, because it's supposed to be a fun project, not supposed to be of any utility. So the fact is that it has lost so much ground is no surprise to me. The lowest traded was in the beginning of this year at 0.0658. Now the market is at 0.0764. It's considered very, very good. But topside, I think it's going to be hard for the market, for this Dogecoin to go beyond 0.08. So I have no opinion on this. But yes, this one is different. This one is actually Cardano, which is touted as a challenger to Ethereum as a blockchain. So you can see that Cardano has actually came mysteriously down to 0.238 before it ramped up to 0.346 this morning. Okay, so not sure what is the reason, but it has taken out a major resistance line. So that is technically bullish. So we want to see, because of the way it goes up, it has been very aggressive. So I was actually hoping for some kind of pullback last week, but it didn't happen. But now this morning it has gone up even higher. And to expect any kind of decent pullback, it may be a little bit of a stretch. But however, there is going to be another level which is going to be even more important, which is the upper resistance line. Okay, and if the current rate goes up, the market will have to seriously go beyond the 40 cents level. Okay, that remains to be seen. Okay, we will have to see. Definitely something is cooking in Cardano, and something is also cooking in Solana. Solana is was unfortunately very associated with the collapse in FTX. For some reason, Solana, because most of the NFT uses Solana, and because FTX blew up, and NFT also blew up, and of course that also negatively impact this particular coin here, which is Solana. Solana went down to as low as $8 before the market ramped up this morning to almost $17. So there's a big recovery here. Okay, again, not sure what is the fundamental behind it, what is the news behind this massive rally this morning. But then again, you can see that this market looks very bullish to me. Okay, regardless of the reason, technically this is a market that you want to buy. Okay, but again, not at this current price. We will see if you can see some kind of pullback. Okay, so in the meantime, that's all I have for you. I've actually spent a lot more longer time than I want to spend with you for this short daily update, but seems to be a market is moving, so I think I will have to give you a little bit of insight. So until tomorrow, I will see you again. In the meantime, you take care and be safe. Bye bye.